in terms of liquidity, why are we seeing such a disconnect? And I mean, we can take a look at net liquidity on the next chart. But
yeah.
Why are we seeing such a big disconnect?
Yeah. This is the tough time, right? This is like gut check time for the framework, if you will, right? Because you look at all these fundamentals and you think the market's efficient, right? And you look at our net liquidity forecast and it's heading straight down into the right, and the S&P 500 is just completely detached from it.
Yeah.
And so at this point, the outcomes, they honestly, they become pretty binary. Either we've reached sort of market lunacy, which the market, regardless of the fundamentals, always reserves the right to just ignore them and just go higher.
Mm-hmm.
I mean, think back to the tech bubble.
Right.
That was lunacy for a very long period of time. And the other outcome is, well, this catches down in a big way, which we think, that's more of a matter of when as opposed to if. But we've had this improving net liquidity environment since last October, and it's possible that the market doesn't see that this is going to roll over starting right now very quickly.
Mm-hmm. Yeah. And what triggers the net liquidity to roll over so quickly?
So the Fed, it's Fed assets minus Treasury General Account minus reverse repo. So Fed assets are going to keep going down. Even though the Fed paused rate hikes, they're not pausing the balance sheet runoff.
Mm-hmm.
So Fed assets going to keep coming down. And then the Treasury General Account, the Treasury during this rebound in net liquidity was releasing liquidity in the system. They had roughly $500 billion sitting at the Fed, and they took that money and they spent it into the economy. And so it was releasing liquidity. And now that the debt ceiling has been lifted, they're going to rebuild the Treasury General Account by issuing debt. And so that all that new debt issuance has to be bought using liquidity. And so it sucks the liquidity back up. So that's what this dynamic is. I mean, it's a huge turning point that you would only really see around a debt ceiling standoff, combined with the Fed reducing the balance sheet at the pace that it is. You normally would not see a reduction in net liquidity like this.
Mm-hmm. Yeah. And what do we need to see this gap start to close? Like what actually would start to happen?
Right. Two ways it can close. One, obviously, is the S&P 500 comes down. Two would be, you look at the different elements of net liquidity. One is the Fed stops rolling off the balance sheet, or even reverses, meaning they start buying assets. Mm-hmm. And maybe that doesn't come through, firm monetary policy, but through these liquidity facilities that have been enacted. All of a sudden, banks start using the Bank Term Funding Program. They haven't really been using it. That would add to Fed assets. Maybe people start using the repo facility, not the reverse, but the repo facility. That would add to Fed assets. That doesn't seem to be in the cards right now, right? And then the other thing could be all of this Treasury issuance gets bought up by those who currently have reverse repo, letting that reverse repo loans roll and buying the Treasury issuance. That would have a zero net liquidity impact. But that's still, that would just make it go sideways, right? So the path of least resistance here is equities come down to liquidity implied fair value. Yeah.
So let's move on to inflation. I guess first question is, and we've got this question from several people, is 3 the new 2?
Mm. Well, that would be very interesting. You can debate this a lot. You would say if the Fed was going to move the goalpost and accept 3, why haven't they done that yet? Mm-hmm. And the other side would say, well, if they're going to do that, they certainly would not have done that yet, because they don't want to be, while they're trying to defeat inflation, they don't want anybody to think inflation expectations could be higher. So if they're going to do something like that, it's going to probably be at Jackson Hole. Mm-hmm. So that's why that'll be watched. And you start to look at these forecast figures and you think, well, that would be a pretty opportune time, because if you look at headline CPI, that's been coming down rapidly, right? And next month, so the June CPI report is where all of the negative base effects are basically going to be out. And so what we mean by that is the decline, the easy part's over, right? Now it's the hard part. And headline CPI from there just goes sideways at 3.5. And then core slowly coming down but still 1 year out running close to 4%. So if the Fed has 11 months looking at 4 on core and 3.5 on headline, and they're 2 years into their inflation fighting battle, maybe that's when they move the goalposts, right? That'd still be tough though. If you're just going to accept higher inflation, that means you're probably going to accept a higher Fed funds rate for longer as well. So anybody who's hoping for cuts, those would also have to come out of the market. So it's not all a good thing that the Fed just accepts higher inflation.
Right.
Right.
So have a great week, and we'll be back next week.